Member of the Michigan Financial Opportunity Corps, and I'm serving at Community Housing Network in Troy, and I will be your presenter for today's webinar, Mastering Money Management by Using a Budget. And also, please be advised, we will provide you with a PDF file of today's entire PowerPoint presentation and the worksheets. And hopefully we are recording this today as well, so we'll send you a copy of that if we can, and then additional resources that you can use to help you build your budget at home. So please try and relax as you learn about the mysteries of building a budget at home. And our topics today include creating your monthly spending and saving plan, also known as a budget, creating your savings and saving for emergencies. Now, in 2019, Debt.com did a survey of 1,000 US adults ages 18 years and older, and they found the following. Nearly all respondents said everyone should use a budget when it comes to managing their money. However, when respondents were asked whether they actually use a budget themselves, only 67% of all respondents use a budget to manage their money. So 1 in 3 people don't budget. Now, comparing the age groups, the survey shows us, surprisingly and impressively, 74% of young people in the age group 23 to 38 years old are budgeting, as compared to only 67% of their elders ages 39 years old and beyond. And of concern are 50% of younger people ages 22 years old and younger who do not budget. Now, Howard Dworkin, chairman of Debt.com, has this to say about debt, as it seems to sneak up on some people unexpectedly. As he says, it's human nature to expect the best and not plan for the worst. So many otherwise smart Americans refuse to budget because they don't think they need it. Then something happens. Serious illness, an accident, a layoff, a natural disaster, think pandemic, or a divorce. In short, in each of these unfortunate and dire situations, there is a loss of income and or increased expenses, and the individual or family is not able to handle this situation financially, and debt can start to accumulate. So in today's webinar, in section 1, we will demonstrate how to prepare a monthly budget, also known as a monthly spending and saving plan, because 2 of the important functions of a budget are to help us manage how we spend our money and how we save our money. So what is a money manager? An effective money manager knows precisely where the money is going today and has a plan for where it needs to go in the future. And this concept is the same for everybody, for those who manage large Fortune 500 companies to a single person or household, in other words, you. And the key takeaways are this: use a monthly budget to guide how you use your money. And by managing your spending effectively, you can achieve personal financial goals such as avoiding unnecessary debt and saving money over time to acquire financial assets in the long term. For example, a house and retirement funds. So the very basic principle that guides money management is to achieve balance, to be zero balance between your income and your expenses every month. However, as we all know, life happens and we come up short, and our income is less than our expenses for the month. So we don't have enough money to cover all of our monthly bills and expenses. Or maybe it's business as usual and we're zero balanced and our income equals our expenses. Or perhaps we're ahead and we have a surplus and our income exceeds our expenses, and after paying our monthly bills and expenses, we have some money left over. So here we have the basic components of a monthly budget. And the budget plan brings together 2 essential money topics: your total net income, So the money you receive after taxes and other deductions are subtracted from your gross income for the month. Your total expenses, how you spend your net income, your money over the next month. And using a budget allows you to do three key things. It allows you to compare your total net income and your expenses for the month. Are you zero balanced, where your income equals your expenses? Are you short, income less than expenses, or a surplus, income exceeds expenses? A budget also helps you understand where you spend your money, how much you spend on fixed expenses, for example, on housing, on variable expenses that fluctuate from month to month, for example, utilities, and how much you spend on discretionary expenses, the non-essentials like entertainment and recreation. And third, a budget helps you make adjustments to your income and expenses so you can use your money effectively by avoiding excessive debt and are able to reach your financial goals over time. So for each month of the year, we prepare a monthly budget plan. And this plan is going to guide us in how we spend our money each month. And there are three basic steps to preparing a monthly budget. In step one, we determine our total net income for the new month. So we know how much money we are going to have coming in. In step two, we determine our total expenses for the new month. So we know how much money is going out. Then in step three, we compare our total net income and our total expenses and calculate the difference by subtracting our total expenses from our total income. And the key question is this: how does our total net income compare to our total expenses? Are we zero balanced? Do we have a surplus? Or are we short and we don't have enough money to cover all of our planned expenses? So why budget our money? Budgeting has benefits, lots of benefits. A budget can help us find ways to save some of our money for the future so we can stop living from paycheck to paycheck. And using a budget can help us avoid the excessive expenses of overspending. For example, a common form of overspending is using a credit card to buy stuff we cannot actually afford. And instead, using a budget, it helps us see, understand what we can afford within our monthly income. And by living within our income, we avoid accumulating debt over time. Using a budget can also help us build a rainy day savings account for small unexpected expenses. For example, $20 for a child's school field trip. Using a budget can help us build an emergency savings account for large unexpected expenses. For example, $600 for new tires on your car. In summary, using a budget helps us understand our monthly income and our expenses so we can avoid excessive debt from overspending and save money for the future. So let's consider the importance of monthly income, the money we have coming in every month. Now imagine, if you will, your finances are like a boat. Then your income, like water, is what keeps your finances afloat. And without income, we would go without many things. With it, income supports our lifestyles. Thus, income drives what we can afford as individuals or as a family. And possible sources of income include earned income, money from a job or service, for example, an AmeriCorps service year. Another possible source of income is money in a savings account or benefits we receive through social services, for example, Social Security income or unemployment income. Another source of possible income would be a side gig or a part-time job bringing in extra money. And then last but not least, gifts, a tax refund, or money from friends or family. So to summarize, in a big picture kind of way, the importance of income is it is the driver that limits the expenses we can afford in our lives as individuals or as a family every month. Now, as we all know, income is taxed. So when we budget every month, we are actually working with our net income. So it's the money left over after taxes and deductions have been subtracted from our gross income. So when we get a paycheck from our employer, our net income is the money we receive when we cash our check or have it direct deposited in our bank account. And here we see an example of net income from an anonymous AmeriCorps member who volunteered to share some of her financial details, including this recent pay stub. Now, this individual is paid twice a month. So here we have her gross income for September through September 30th, $621 on this pay stub for that period of time for earned income. And then the deductions are below it, also known as withholdings. And that includes Social Security, Medicare, federal taxes, and state taxes. So this AmeriCorps member received a net income of $553.46 for half the month of September. Now she earns the same amount every month as an AmeriCorps member, so her hours never fluctuate. So for every month, she receives 2 biweekly paychecks of $553.46. So for the entire month, her net income is twice that amount, $1,107 per month. Next, we are going to talk about expenses, what we spend our money on, thus money going out. And expenses can be divided into many different types. There is a whole alphabet soup of different kinds of expenses. We're going to use a simplified approach in which there are 2 basic types of expenses. The first type are the mandatory expenses, what I call the hammer and the nut expense, because these are expenses in which we have no choice or very limited choice. We have to pay them because they are our responsibility. Thus, they are paid as is. And an example of a hammer and nut expense would be the monthly utility expenses like the electric bill or the heating bill. And then the second type, a basic type of expense, are optional expenses, in which we have many choices, options, represented by this little humanoid trying to figure out what options, what stuff is he or she going to buy. Stuff like groceries, clothing, gasoline for the car. We choose what brand, do we go expensive or cheap? How much do we buy? Again, we have choices with optional expenses. Next, we have what I call the simplified monthly budget equation, in which we bring together the building blocks of a budget, our income, thus money that comes in each month, and then we subtract our expenses, money that goes out each month. And the budget equation shows us that there are 3 building blocks that we use to build a budget. So in this simplified budget equation, we start with building block number 2, our monthly total net income. And we subtract building block number 1, our monthly mandatory expenses, giving us the leftovers, the money remaining, which we can use to pay for building block number 3, our monthly optional expenses. That is the essence of the simplified budget equation, as there are essentially only 2 basic ways we spend our money. We spend our money on the stuff that's mandatory, and then we spend it on the stuff that's optional. Now, www.moneyunder30.com created a worksheet based on the budget equation called the Simplified Budget Worksheet. And this worksheet shows us how to use the 3 building blocks to create a budget. And I'm going to show you how to use their worksheet to build a budget at home. Now, I actually use this worksheet myself every month, and it has revolutionized budgeting for me. I used to hate budgeting, and this worksheet has made it a lot easier for me. That said, it is important for you to find or continue to use the budget method that works for you. So now we're going to build a budget for a real person and actually fill out step by step the budget worksheet for the anonymous AmeriCorps member I mentioned earlier, who has provided us with her financial details for the month of September. And I hope this will help us see how to put together a budget pretty quickly. And again, as a reminder, please be advised you will receive a PDF file of today's PowerPoint, as well as a recording, we hope, and the resources that you need to build a budget at home. Now, in this example, the cartoon is pretty much what an AmeriCorps member looks like when preparing their monthly budget. She is seated at her desk, armed with a computer and internet access to monthly pay stubs, monthly bills, and credit card statements. And she is going into battle to prepare her monthly budget. And each of us will need to do the same when we prepare our budget at home. So we start with the AmeriCorps member's first mandatory expense in Section 1, housing. Now she has a rent payment of $600. So she needs to budget in Section 1 housing her rent of $600 for the month. Next, continuing with mandatory expenses in Section 2, debt, she has a car payment, specifically a monthly lease payment of $125 on the car she drives. She also has a Discover credit card debt with a revolving balance of $2,730 that carries over from month to month with added interest because she cannot afford to pay off the entire balance in one payment. So when income is limited, the best one can do in the short term is to pay the monthly minimum on a credit card bill. Now, with the pandemic, her student loan is in forbearance right now. So her current loan payment is $0. And that's it for her debt obligations. So adding up her debt payments for the month, the $125 plus the $55, she will need to budget $180 total for her mandatory debt expense in Section 2. And here are the AmeriCorps members' billing statements for her other mandatory expenses in Section 3. Her State Farm insurance bill, which covers her renter's insurance and her car insurance, of $10 a month and $70 a month for the car. As an AmeriCorps member, she is a low-income person and she is eligible for Medicaid, so she currently has a health insurance premium of $0. Because it's September, she hasn't fired up the furnace yet, so her consumer's energy bill is $0. Her electric bill is $40 from DTE. Infinity charges her $30 a month for internet, and her Pure Talk cell phone bill is $20. So when we add all of that up, she has other mandatory expenses of $170, which she enters in Section 3, other mandatory expenses on the worksheet. Now in section 4 on the worksheet, we are dealing with savings. And savings is a mandatory expense if we have room in our budget. So this is an important mandatory expense as we've seen before, savings is important. Therefore, it is an important mandatory expense if we can afford it. If we can't afford it, we set aside nothing, as we can only do what we can do at the moment. So the AmeriCorps member would like to set aside money in an emergency savings account, but for her, money is very tight right now due to her limited income. So she won't be setting aside any money for an emergency savings account, for retirement, or any money towards an extra credit card payment. So she will enter $0 in section 4 on her worksheet. So at this point, all mandatory expenses have been entered into the budget worksheet in sections 1 through 4 for the AmeriCorps member. $600 for housing in section 1, $180 for debt in section 2, $170 for other mandatory expenses in section 3, and $0 for savings in section 4. We add it all up and we get her total nut, which is $950 of mandatory expenses for the month. And we have our first building block number 1, $950 for mandatory expenses for the month in total. So as we continue to work our way down the worksheet, next we are going to consider net monthly income. And to do this, we consider the AmeriCorps member's source of monthly income, of which she has a single source of earned income. And here is her pay stub, which we saw earlier. And as we said then, she has a biweekly paycheck. And so the grand total that she gets net income each month is $1,107. And we enter that in section 6 on the budget worksheet, 1,107. And we have building block number 2 as we continue to build our budget. Now comes the reality check in section 7. And these are the optional expenses on the budget worksheet. We are going to calculate the AmeriCorps member's optional expenses she is allowed, that she can afford. This is the third building block we need to build her budget. And to do this, we use our old friend, the budget equation. Starting with a total net income of $1,107 from section 6 on the worksheet, we subtract her total nut of $950 of mandatory expenses from section 5, leaving her $157 to cover her optional expenses for the month. And we enter this in section 7 on the worksheet. So she has a monthly spending allowance of $157, which she will use to pay for various optional expenses for the month. She can spend the entire $157 or spend less than $157, her choice. Now, your optional expenses, of course, depend upon you and your personal priorities. For the AmeriCorps member, her optional expenses include food, gasoline, personal care, clothing and laundry, technology for small electronics, entertainment, recreation, subscriptions, and some fun money. And she spends modest amounts of money on each category. And we also notice that she looks for other options in the community. For example, for food, she uses a local food pantry and SNAP benefits in addition to the $30 that she has set aside from her spending allowance. She limits her driving to essential mileage only. For clothing, she shops at the Salvation Army, and the library is a resource for entertainment like DVDs and recreation such as free activities, as well as local parks and trails. And she has allotted some fun money, $27 that she can spend on whatever she wants during the month. So here on the right side is the simplified budget worksheet for use at home to prepare a monthly budget. Now, if you need to make additional entries in sections in any of the sections of the budget worksheet, I prepared an additional worksheet on the left side called a register, which you can use to include additional types of mandatory expenses related to debt in section 2, additional expenses related to other mandatory expenses in section 3, additional savings opportunities in section 4, and in section 6, additional options for additional money coming in each month. You can sum up each little section and then transfer that information over to the main budget sheet on the right side. As we bring section 1 to a close, we have some general comments to make regarding budgeting. Now, the simplified budget worksheet just presented is also known as a zero-based budget, in which we spend our entire income each month on mandatory expenses and optional expenses, with $0 remaining at the end of the month. Basically, every dollar of monthly net income has a purpose and is spent, as we saw with the AmeriCorps member. And then also, there are actually many different kinds of budget methods. And very recently, I came across an article entitled 10 Budgeting Methods to Help You Take Control of Your Money. And the methods suggested by the author depend upon one's level of income as compared to their total expenses on a monthly basis, and by how much detail you personally want in your budget. Now, the article web link is included at the end of this PowerPoint presentation for your reference. And the bottom line is this, again, choose a budget method that works for you and that helps you avoid monthly money shortages. And on this slide are some tips to use on a monthly basis, and you can review these at home. And the one tip I would emphasize in this whole budgeting process is to be organized. Prepare and use a budget every month, and keep a calendar, and do your best to pay your bills on time. So now we're going to switch gears and move into section 2. Now, one of the great money management challenges is when our money is short and we don't have enough income to cover our expenses for the month. And we see this here with this balance beam scale, which allows us to compare our total monthly expenses and our total monthly net income. And we see that the weight, the burden of our total expenses exceeds the weight of our total net income, and money is short for the month. So we need to fix this situation. We have to go back to the two key money components. We need to make changes to make adjustments in our monthly expenses and our monthly net income. And this slide provides an overview of how to fix a money shortage. And please remember, there is no shame, no blame when money shortages happen. Even with the most careful planning, unexpected events happen. For example, the pandemic, a job loss, reduced work hours, unexpected expenses for things like car repairs. Stuff happens. So what can we do? We swing into action and make adjustments in our expenses and our income. We apply what I call Plan A and Plan B. So starting with Plan A, we are going to attempt to fix the shortage on our own. We're going to make adjustments in our monthly budget by attempting to decrease our expenses and or increase our income. So we are going to shift the balance from a money shortage on the left, where our expenses exceed our income. We're going to shift to the right to a money surplus, where our income exceeds our expenses. And we do this by making adjustments on our own. We look for ways to reduce our expenses, to cut costs, and ways to increase our income. And in the process, we shift the balance beam from a shortage to a surplus. That is our mission. Now, here are some examples of ways to decrease our expenses to cut costs. What can we eliminate? For example, expensive takeout meals. What can we conserve, use less of? For example, the heating bill. Lower the thermostat to 68 degrees during the day and lower it even further at night when sleeping. What can we get cheaper? For example, I love pizza, yet I can't afford $15 to $20 for a pizza from Jets or anywhere else. Instead, I splurge on a $2.19 frozen pizza from Aldi, and that works for me. A third option, when it comes to decreasing expenses, is to modify. So what expenses can we renegotiate? And we'll cover this next in Plan B. So to summarize, when it comes to expenses, the mission here is to make an expense adjustment, reduce total expenses to help become better balanced with monthly total income. Now, when attempting to reduce expenses, it can also be helpful to consider external influences that encourage us to buy stuff, maybe stuff we don't really need. This can include internet ads, sales. For example, our most recent shopping holidays, Black Friday and Cyber Monday. Limited time offers, for example, 50% off if responding in the next 48 hours. And then watching what everyone else is buying on social media, celebrities, friends, and peers. The trick is to stay focused. Recognize tactics used by advertisers, for example, pop-up ads. Notice when and where you're tempted. For example, for me, walking into Kroger is a dangerous opportunity to spend money I don't have. So control your environment. For example, I shop with a list when I look for groceries, and I avoid buying anything else that's not on the list. And then finally, build in a pause before you buy, especially with expensive purchases. Try to talk yourself out of it. Remind yourself, I would be in serious trouble if. For example, for me, my monthly temptation remains a $170 pair of Western cowboy boots that I'm stuck on. It's a potential purchase that makes absolutely no sense at all. So every month I remind myself of this nonsense as I check out the latest cowboy boot price on Amazon. And I actually do this. It's like tempting fate. And I walk away. And for me, it's a moment of success because I'm managing my urge to spend money on something I don't need, a non-essential expense. Also, when money is short, increasing our income can obviously help us cover expenses. And this slide is an overview of various ways to do just that. So consider the possibility of one of these options and whether it might apply in your situation. For example, we can sell stuff we're no longer using, like electronics or small kitchen appliances on eBay, finding temporary employment on Indeed.com to bring in short-term income, finding part-time employment, a second job on Indeed.com to bring in ongoing extra income. For example, I did that in the fall of 2019. I worked in a restaurant in the back of the house while serving as an AmeriCorps member. It was hard work, and yet it helped supplement my living allowance from AmeriCorps with this extra income, and it helped me avoid monthly money shortages. And then in the longer term, we might consider pursuing another career through workforce development. For example, a community college certificate, skilled trades programs, or maybe a Michigan Works program. Another possibility might be obtaining a short-term loan from friends or family, a bank, a credit union, or a community loan center. Now, not recommended because they are expensive and can be enormously difficult to pay off due to high interest rates, are payday loans. Another one are the auto title loans, which are very risky because they are also enormously difficult to pay off, and you could lose your car in the process. And pawn shop loans can also be difficult to pay off, and you could lose your stuff. So when facing a money shortage, it is important to consider additional sources of income. And the mission is to make an income adjustment to increase total income to help become better balanced with total monthly expenses. So now we've done everything we can think of to cut our expenses, and we even increased our income. So Plan A helped, but it is still not quite enough. We're still short, and our expenses still exceed our income. This is the beginning of a crisis because we may not be able to pay all of our bills, and the bills don't stop coming. Every month there's another one. In the case of our AmeriCorps member, her $600 rent payment, her $125 on the car payment, $40 on her electric bill, the $70 auto insurance premium, etc. So what can be done? The next step is Plan B. It's time to speak up. We go back to our expenses again. And this time we're going to attempt to decrease expenses by asking for help. And we're going after the big bills. For example, the $600 rent or mortgage payment. And so we contact our landlord, our mortgage holder, our creditors early before our debt starts piling up. And there's a process. Be prepared before you make contact. Think about what you can do, know your budget, and what you can afford to pay right now. Then notify your creditor and tell them, I'm having trouble paying my bill. Then ask, inquire about possible options. Then do the same process with your creditors early. And then also reach out for help in your community. Call 211, which can get you connected to other sources of help. Rent assistance. For example, in Michigan right now with the eviction diversion programs, they can help with delinquent rent. Other types of assistance include food, utilities, and low-cost internet and phone service. So in summary, the mission of Plan B is to modify the payments of our big bills, and by asking for help early, before our debt starts piling up, our creditors can see we are responsible, we recognize our situation, and we want to work with them in paying off our bills. And with community assistance, we can decrease our expenses for food, utilities, internet, and phone, and potentially for housing. And this slide is a summary of money management when money is short and handling the great money management challenge, money shortages. Plan A and Plan B. And this is our last section, section 3, and it will be brief. So now we're going to shift our focus from spending your money on all your mandatory expenses and your optional expenses to saving your money by using a budget to create savings. So far in this presentation, we have talked a lot about spending money, and we have focused heavily on two key money topics: our total net income and our total expenses. And we have also talked a lot about the great money challenge, money shortages. Well, it turns out saving money is also a form of money management that involves the same two key money topics: your monthly total net income and your total expenses. So here's a question: when can we save money? And the short answer is we can save money when our total monthly net income exceeds our total monthly expenses, which sounds familiar. We've seen this before. When there's a money surplus and we have money left over after we have covered all of our total monthly expenses. So a money surplus is the savings opportunity. But what if we are short of money, or we are zero balanced and our income equals our expenses? We still have to create a surplus in order to save money. And we can do this by decreasing our expenses or increasing our income, or both. So by definition, saving is setting aside money for your future. And one of the ways to build savings is to spend less money. Then put some or all of what you don't spend into a savings account. For example, the easiest way to save is to eliminate a non-essential expense. For example, money I might usually spend on entertainment or recreation, and to set aside some of that money in a savings account. Another way to build savings is to earn more money, then put some or all of the extra money into a savings account. For example, money from working extra hours, an extra part-time job, or a small windfall like a tax refund. And ask yourself, why save money? Goals: buying a house, saving money for an emergency savings account, which can cover unexpected expenses like major car repairs. We can save money for periods with decreased income, for example, when we have reduced hours. We can save money to cover increased expenses for peace of mind. We can save money long-term for retirement savings like IRAs, Roth IRAs, and 401ks. And of course, you can save money for goals that are personally a priority and are very important for you. Now, switching gears, we'll now touch upon saving for emergencies. And by definition, an emergency refers to a high priority situation necessitating action. Essentially, there's little time to plan, and instead it's time to take action. So saving for an emergency fund is likely one of the most important savings accounts to have because life happens. For example, recently, while driving down M59, I had a sudden flat tire. Later, at the discount tire shop, I discovered I needed to replace all 4 of my tires, and it was going to cost me $678. This is a very painful example of what a financial emergency is. because in my case, I had little choice. Fix it now or suffer a potentially worse outcome later. So it's a good idea to prepare ahead of time for emergencies. Setting aside $500 to $1,000 can cover large unexpected expenses. And if I pay for unexpected expenses with money saved, I avoid creating new debt, which would happen if I had to swing out one of my credit cards. Now, creating an emergency fund takes time and commitment, making monthly deposits when we can over many months or years. Still, it is worth doing because an emergency fund is a key step to improve your financial health and stability, as we're not thrown into chaos when we suddenly have to come up with money to cover large expenses like a major car repair. Instead, we can withdraw the money from our emergency fund to cover the unexpected expense instead of using a credit card and creating new debt. So as you manage your money and look to your future, be successful by creating a goal now, your emergency savings fund. This slide is from the FDIC Money Smart Savings Module with specific details on how to create a goal, a SMART goal. And we have a specific example in the next slide that shows us how to do this. Now, SMART goals have a plan and a deadline. And here is a goal to create an emergency savings fund. But first, before we go through the example, here are the steps, the criteria for setting up a SMART goal. A SMART goal is specific, it's measurable, it's action-oriented, it's reachable, and it's time-bound. And in the example, I will save $1,000 in my emergency savings fund. So my goal is specific, $1,000. By saving $10 once a week. So my goal is measurable. It should be increasing by $10 each week. And I will do this by depositing $20 when I cash my biweekly paycheck. So my goal is action-oriented. That's my action. And $20 is 1.9% of the total amount of money I receive in my check. So my goal is reachable. It's reasonable. And this will start on October 1st of 2020 and will end on September 1st of 2022. So there's a deadline. It's time bound. So in summary, the suggestion is made to create a SMART goal to help you establish your emergency savings fund in whatever manner you choose to do. And lastly, here is an idea for easing into a small emergency fund or a rainy day savings fund. And it's called the 52-week money challenge. And one starts small, depositing $1 into a new emergency fund in the first week. And then after each week that follows, increase the weekly deposit by $1. Then by the last week, the 52nd week, deposit $52. And the grand total after 1 year is $1,378. Now, if you apply the 52-week method based on your current monthly net income, at some point you may reach the limit of what you can afford to save in your emergency savings account each week, based upon what your budget gives you for your monthly spending allowance. So now you know what your budget can handle as a savings expense, and you can set aside this fixed amount every month. And after 52 weeks, you will have saved a tidy sum in your emergency savings account based upon what you can afford. That is wonderful. It doesn't have to be the entire $1,378. For example, if we save $3 a week, at the end of 52 weeks, we will have saved $156. Personally, I think that is fantastic. Any money that we are able to save for the future is a plus. And please be advised, there may be some weeks or months when you can't set aside any money in the account. That's okay. Do the best you can when you can. Then, when your monthly total net income increases once again, start your savings once again and increasing your monthly contribution over time until you reach your new savings account limit that you can set aside each week. Save something from your income and build your savings over time. And I think you will be amazed after many months and years what you have been able to save. And then when an emergency arises, take some money from your emergency savings account to cover the expense, and then build it back up again so that you are prepared for an emergency in the future, should one arise. And so, as you can see, we're approaching the very end of the presentation, and I'm going to share with you the resources that we will provide. And here we have the budget worksheet to the right and the register on the left side that can help you get organized in greater detail if you need it to prepare the budget worksheet to the right. And you can print this at home, the slide in its entirety on an 8.5 by 11 sheet of paper, and the whole thing will fit, and you're all set with that. And then here is the article I found on the internet, 10 budgeting methods to help you take control of your money. Again, it is important to choose a budget method that works for you and helps you achieve your financial goals and helps you avoid monthly shortages. And you see the link to the article below, and this is for your reference. And I included this slide, and the reason why I did this, and it's a little bit detailed, this is a new addition to the presentation, and it is an article I found on the internet from the website called The Simple Dollar on Creating a Monthly Budget When Your Monthly Net Income Fluctuates from Month to Month. As we saw with the AmeriCorps member, her income was fixed. It was the exact same amount each month, so it was easier for her to budget. And when our income fluctuates from month to month, it can be more difficult. For example, if we earn hourly wages and our work hours vary from month to month, then our income is also going to vary from month to month too. So how do we create a monthly budget with any certainty? For example, a January budget. So to create a January budget, in other words, we're going to budget for our January expenses. What we want to do is we want to use our income from our December paychecks, which we will have in hand at the end of December. And those paychecks, we can add every single one of those paychecks up. That's going to be our net income, which we earned in December. And then we're going to apply that to our expenses in January. So we know exactly how much income we had in December, and then we budget within that amount of income for our January expenses. And I've included a little table for the entire year. So for February expenses, we would use our paychecks from January, and that's how you want to budget. And I've included the link down here, and this article was written by Holly Johnson, and its title is 9 Keys to Budgeting on a Fluctuating Income. And this was step 4 in her article. So if you would like to refer to that and learn a little bit more, the link is there for that in case your income fluctuates from month to month. And then last but not least, it can be very helpful to create a budget with one-to-one assistance with a financial coach who can personally work with you in preparing your monthly budget. And you can find such help at a local financial empowerment center in your community. And here is the flyer for residents in Oakland County for their financial empowerment center and the contact information. Next, here is the Financial Empowerment Center information for Macomb County and their contact details. And then we have the same for Wayne County's Financial Empowerment Center and their contact details. In Detroit, the Financial Empowerment Center there and their contact details. And then if you live in Flint, we have the Financial Empowerment Center and contact details here. And so that brings us to the end of our presentation today. Thank you for attending today's webinar. It is our hope that today's presentation has helped you gain a better understanding of how to prepare a budget and how important it is so that you can manage your money more effectively and accomplish your financial goals. So thank you. And I know we've covered a lot of material today. So if we have any questions, we're available now to answer any of those. And then last but not least, we will send you an email with all of the resources as well as a survey, which we would really appreciate it if you could complete it. It's a very brief survey and it will help us do a better job of presenting this information in the future. So thank you.